Good day, ladies and gentlemen, and welcome to our webinar on trading volatility. Now, please, when you have a second, click down below on the bell icon and also on the subscribe button and subscribe to our YouTube channel. It's very important to us and we appreciate it. I promise not to barrage you with mail. You only get notices when I upload new videos. Now, understanding volatility is very important. The natural rhythm of the market is not only trending and consolidation, but we also have to deal with different types of volatility. Volatility is the measure of how drastically a market's price changes. A market's liquidity has a big impact on how volatile the market prices are. Lower liquidity usually results in more volatile markets and causes prices to change drastically. Higher liquidity usually creates a less volatile market in which prices don't fluctuate as drastically. Liquid markets such as Forex tend to move in smaller increments because their high liquidity results in lower volatility. More traders trading at the same time usually results in the price making small moves up and down. However, drastic and sudden movements are also possible in the Forex market. Since currencies are affected by so many political, economic, and social events, there are many occurrences that cause prices to become volatile. For instance, we had the Brexit vote. The pound went tumbling. We had when the Swiss National Bank pulled out the peg on the Swissy. We saw the euro and the Swissy go hog wild. We've seen lots of volatility just recently with the virus, where people are running to what we call safe haven currencies. So we do get all types of volatility. Traders should be mindful of current events and keep up on financial news in order to find potential profits and to better avoid potential losses. So this is where volatility and using volatility indicators can help you trade more effectively and keep your expectations in check. Volatile periods in the market can, in the worst scenario, create wild and sharp swings in the market, which can make them difficult to trade. But a volatile market can be the Forex trader's best friend. We often see extreme volatility after certain news releases and world events that are extreme in nature, and this type of action is easily seen on price charts. Volatility can be more subtle, which we can see during extended runs during trending markets and more muted volatility during consolidation periods. Each of these type of environments are going to have different types of market approaches that can be used. We as traders we don't want to trade a quiet market. Investors, yes. As traders, we need that volatility because we can trade going up or we can trade coming down. We don't want to sit there with the euro trading at 111.52 and all day long it goes from 111.52 to 111.53 to 111.52. We can't make any money. We need something to send the euro from 111.52 to 12.01, and then it can ease back down to 12.11.52. We need that volatility. Trending types of systems looking to take advantage of individual swings or longer positions until there is a change in the trend. Higher volatility also gives us breakout systems will take advantage of this volatility that arises when there's a true breakout of a consolidation. We also have low volatility. You can utilize something like a trading channel system, which can be trend line channels and some type of bands, or you can use something like reversion systems. But low volatility doesn't really, it's a much slower type trading environment. If you were trading between the price moving between a support and resistance level, and you just wanted to tick up, and you open a price on a share at say at 32.50, and it's got a resistance level at 33. Okay, you bought your position at 32.50. You're waiting for it to click up to 33, and you're going to take your profit. Well, you take your little bit of profit. Well, that could take you all day in a low volatile market. Or would you be happier with it pushing up to 33, you take your profit, falls back down to 32.50 again, and you can open up another trade up to 33, and you can do this many times a day. So when it comes to making money in the financial markets, there must be price movements, with Forex volatility being crucial for short-term investors. Day traders, for example, depend on hourly price changes, and without fluctuations, there would be no scope for profit. Volatility is also essential for swing traders who work on a slightly longer time frame. Swing traders often use technical indicators to analyze the volatility of the market to decide when it's best to exit or enter a trade. These indicators can help predict bullish and bearish trends. Now, conservative long-term traders prefer to follow the buy and hold strategy, meaning they hold currencies for longer periods than short-term traders. But most of us here are CFD and Forex traders. We're a variation of a day trader, but a CFD allows us to hold on to that position a little bit longer, but it doesn't really set up for holding on for a position for long periods of time. So as with short-term trading approaches, Forex volatility is also essential when it comes to making money from the markets. The general thought behind long-term trading is that price fluctuations will result in a profit over an extended period of time. Now, this strategy requires patience and an extensive trading knowledge. It also requires a big capital outlay. The volatility of the Forex markets is what many traders thrive on as they enjoy the adrenaline rush that comes with watching price movements and trends. That said, volatile markets come with plenty of risk, and therefore it's really important to manage your trading decisions carefully and to do plenty of research before placing a trade. Inadequate risk management is the downfall of many traders. Failing to enter or exit a trade at the right time can prove costly, which is why Forex traders use a wealth of essential indicators such as Bollinger Bands, RSI, volume, and establish support and resistance levels to aid in their strategies. Investors looking for returns with minimal risk often choose portfolios with lower volatility rather than opting for portfolios which could either have big wins or huge losses. To conclude, different traders' perspectives perceive volatility in different ways, and it has a lot to do with an investor's attitude towards risk and what an investor's goals are. Forex volatility can either raise profits potentially or cause unnecessary loss, making it crucial to continually track market trends and analyze them. This is particularly necessary during times of political and economic instability, as both can heavily impact the Forex markets. Knowing what phase the market is in will assist you in looking for the right tool for the job. You probably don't know what to look for in the longer term trending plays inside of a low volatility consolidation area. You would be letting positions ride when a reversal takes place, which will have a detrimental impact on your trading account. Inside every charting platform, there are tools called volatility indicators that will help you objectively measure the level of volatility. And it's important to fully understand the tools you're going to use. Now keep in mind that there are no best chart indicators to use. A lot is picking and tweaking your indicator. This applies to any market, including Forex and futures. Apply it to your chart using the standard settings, and then you should help adjust it or customize it when you start to see how volatility works with price action or the type of market we are in.
I often see extreme volatility after certain news releases and world events that are extreme in nature, and this type of action is easily seen on the chart. But volatility can be more subtle, which we will see during extended runs during trending markets and more muted volatility during the consolidation phases. Each of these types of environments are going to have different types of market approaches that can be used. In high volatility, trending types of systems that look to take advantage of individual swings or longer positions until there's a change in the trend. Breakout system will take advantage of the volatility that arises when there's a true breakout of a consolidation pattern. In low volatility, you can utilize channel trading, which could be trendline channels or some type of bands. Reversion systems will have you taking positions when market reach a support or resistance zone that contains the consolidation. Knowing what phase the market is in will assist you in using the right tool for the job. And you probably don't want to look for longer term trending plays inside of a low volatility consolidation area. You'd be letting positions ride when the reversal takes place, which is going to have a detrimental impact on your trading account. Now, inside of every charting platform, there are tools that are called volatility indicators. They'll help you objectively measure the level of volatility, and it's really important to fully understand the tool that you're going to be using. Keep in mind, there's no best volatility indicator to use, so don't spend too much time picking and tweaking the indicator values. Now, this applies to any market, including Forex and futures. Apply it to your chart using the standard setting, and that should really help you begin to learn how to see volatility in the price action.
Now, one of the most popular indicators is called ADX. ADX indicator measures the strength of a trend based on highs and lows of the price bars over a specified number of bars, typically 14. Generally, an ADX crossing the 20 or 25 level is considered the beginning of a trend, either an uptrend or a downtrend. A move down in the ADX is considered a signal the end of a trend, while a ADX below 20 or 25, the market is usually in a consolidation period. As long as ADX continues to rise, the trend remains strong. This can objectively show that the strength of a move has softened, and any position in the price trend direction.
ADX indicator measures the strength of a trend based on the highs and lows of the price bars over a specified number of bars, typically 14. Generally, an ADX crossing of the 20 or 25 level is considered the beginning of a trend, either uptrend or downtrend. A move down in the ADX is considered to signal the end of a trend. And while the ADX is below 20 or 25, the market is usually in a consolidation pattern. And as long as the ADX continues to rise, the trend remains strong. But once it starts to turn down, the trend is weakening. This chart here shows a strong trend in place on the left, and as price is showing consolidation periods and no strong price thrusts, the ADX peaks and slopes downwards with occasional upturns. This can objectively show you the strength of the move. It has softened, and any positions in the price trend direction should really be managed pretty closely. To the far right of the chart, we see an upturn from below 20 with an upturn in the ADX. This can indicate the volatility has returned to the market, and you may want to adapt your trading approach to suit the new reality. Now, the ADX has two drawbacks that you must be aware of before thinking you found the holy grail here. Number one, it does not indicate the direction of the trend. For that, it's really combined with the directional indicator, plus DI and negative DI, and as a matter of fact, the ADX calculation is based on the DI. It's easy enough, however, to determine the trend visually with the use of a simple moving average or using the typical trending price description. Number two, as is the case with most indicators, the ADX is a lagging indicator. It signals the beginning or the end of a trend after the fact. With proper risk management, however, that can still allow us to profit from the bulk of a strong move. Compare the move of the ADX and the condition of price in the graphic and see what else you can learn from this chart that may apply to your own trading. Now, the AT
should be managed closely. ADX has two drawbacks, though. It's a lagging indicator, and it doesn't tell you which direction trend is going. But we also have other indicators. We have ATR. ATR measures the true range of a specified number of price bars. Again, typically 14. The true range differs from a simple range in that it includes the close of the prior bar in its calculations. ATR is a pure volatility measure and does not necessarily indicate trend. The best way to use ATR is an indication of a change in the nature of the markets. ATR has the same drawbacks as ATX. It does not indicate direction, and it's a lagging indicator, and it doesn't work in ranges when prices are ranging. And then we have Bollinger Bands. Bollinger Bands is a very popular indicator that also, one of the things, it shows volatility. Bollinger Band uses a standard deviation above and below a moving average. And these standard deviations will help us see how price is moving in this range. When price reaches the upper or the lower band and breaks out, we can see that the markets are volatile. So unlike ADX and ATR, Bollinger Bands indicates both volatility and direction. When price volatility is high and the bands widen, when it's low and the bands tighten, since it is possible to have high volatility during consolidation, typically chopping periods will have wide bands moving sideways, as you can see here in our highlight. When price transitions into a trend, the bands will widen and slope up or down. So a simple trading method using the information in Bollinger Bands is telling us that it could be wait for price to poke outside the bands, which indicates a large deviation from normal price, hence volatility. Price pullbacks to the area around the 20-period moving average, which is the center of the bands. And then look for a price pattern to indicate a reversal in price. Bollinger Bands are an excellent volatility and trend indicator, but like all indicators, they are not perfect. There are some distinct differences between volatility and risk. This is what a lot of people mess up, and make a mistake with. Volatility is out of your control, whereas risk is not. You can decide exactly how much you are willing to and able to manage. However, the relationship between the two is very strong. The higher the volatility, the higher the risk. Trading volatile currencies always carries risk because price could move sharply in any direction at any time, thus magnifying losses as well as gains. One common trend that emerges in Forex trading involves a degree of herd mentality. Traders decide to take a chance on a volatile market, largely influenced by the fact that other traders are taking the same action. In the event of market crash, traders will sell at a lower price, potentially incurring bigger losses. You always need to be fully aware of risk and weigh up the pros and cons of any trade, especially when a market is volatile. Never take a risk based on popular opinion, and always use your own judgment, employing your personal risk management strategy to make sure you trade with a level of risk you can afford. There are some specific Forex volatility trading strategies and tips you can use. These will help you make the most of your trades, but importantly, they also help you to minimize your risk. Volatile markets are always risky. So, some of the best tips I can give you for trading a volatile market is trade using charts and indicators. Trade around news events. Use stop losses. Keep your position size low. Adhere to your Forex trading strategy and keep a trading journal. So, as mentioned, there are various technical indicators you can use to anticipate market sentiment and make predictions about future price direction. While not definitive, using charts and indicators will help you formulate your strategy and choose when to trade. I mentioned before, trading news events. Following news and current affairs can alert you to events that might have an economic impact and affect the value of a currency. You should always be aware of what is on the economics counter and the possible volatility that it can occur in the markets. Stop losses are primary preventative measures. It's always a good practice to use stop losses to minimize risk. The higher the volatility, the closer your stop losses should be. Although, in order not to get stopped out, you need to be able to place them outside of the volatility area. Otherwise, you'll tend to get stopped out in all of your trades. And also, too many traders want to make too much money. During a volatile market, because you have to set your risk-reward ratios, okay, also keep in mind your position size. You can lower your position size and therefore lower your risk. And always don't adhere to your trading strategy. Don't get your emotions involved. Don't get too excited. Don't say, here's a chance to make lots of money and get yourself messed up. Always follow your strategy and your plan. And keep a trading journal. A journal is the most important thing. It is your historic reference of what happened when a market did certain things. So next time you see this volatility occurring, or next time this economic event is happening, you can go back and see exactly what happened, what you did, what you should have done, and did you or did you not make profit. So keep in mind that nothing is perfect, and optimizing indicators such as the ones we've talked about for volatility can have your curve fitting a trading system. This is dangerous practice. Don't force your indicators to fit what you want it to do. Use your indicators to filter out your bad trades. So thank you very much for joining us, and I hope you learned a little bit about trading in volatile markets and understanding volatility. And remember, please subscribe to us at YouTube. Bye now.